Hi, everyone, and welcome to today's webinar, Managing Tax Compliance Risk, Preparing for Growth, and Audit Readiness. Today, we have a special presentation. Our presenters, Steve and Scott, initially presented this at Avalara Crush conference in November. Crush is our conference for customers and partners to discuss trends and best practices in tax compliance and to have some fun too. So we took some of the top performing sessions from Crush and have turned that into a webinar series. So this is the second in our Crush Replay series. There are a couple sessions remaining, so you can check those out under the Additional Resources tab. Before we get into the presentation, just a friendly reminder that Avalara cannot provide legal or tax advice. On your screen is our safe harbor policy. Please take a moment to review that while I continue with some additional housekeeping. We are recording today's event, so if you want to listen to it again or share it with a colleague, you'll receive the recording later today. The console you're looking at can be customized, so feel free to move or resize the windows. The slides can be resized by dragging the bottom corner. The Additional Resources section contains some helpful related resources, including today's slide deck in a PDF. There are several ways to engage with presenters and attendees today. First, if you have any questions, please submit them using the Ask a Question box. We will try and save some time at the end for Q&A. You can also submit any webinar troubleshooting questions there, and I will help you out. Second, you can join our attendee chat. There is an icon at the bottom of your screen with 2 chat bubbles. If you click that, the attendee chat will pop up on your screen. So we encourage you to introduce yourself, network, and discuss today's topic. So drop in the team chat where you're calling in from today. Third, you can react to the presentation by clicking on the emoji icon and giving the presenters a thumbs up or a heart, or some various other reactions are there too. We are offering 1 CP credit for today's presentation. For those looking to receive CP credit, please note that we will ask you to respond to 3 of our 4 poll questions. The poll questions will pop up on your screen for a limited amount of time, so please make sure you're ready to answer when that appears. We recommend that you do not split or tile screens on your computer, as this can affect the placement of the poll question. We've also heard from previous attendees that the poll questions don't display well on mobile, so please try and get to a desktop if you are able. And then you must attend 50 minutes of the presentation to qualify. So once you've met those requirements, your certificate will be available to download in the Earn Certification box on your screen. You'll click the icon to access it. Your certificate will also be sent in a post-event email. Unfortunately, we are unable to provide CP credit to those who have technology issues that prevent them from qualifying. If you do experience any technology issues, please reach out as soon as possible using that Ask a Question box so we can document the issue. And lastly, if you have a moment, you can respond to the survey questions following the webinar. All right, let's meet today's presenters. So first we are joined by Steve. Steve, can you take a moment to introduce yourself?
Yes, hi everybody. Again, my name's Stephen Kibber. I'm a CPA and also a former California sales tax auditor. Combined years for that was about 21 years. And so my last position was at RSM, Grant Thornton and Deloitte. So coming over to Avalara, I've been here about 8 years. So going on 30 years. And so I'm happy to speak about my experiences in audit and consulting.
Great, thank you, Steve. And then we are also joined by Scott Peterson, a familiar face in a lot of our webinars. Scott, can you take a moment to introduce yourself?
Thank you, Ashley. Yeah, my name's Scott Peterson, and I'm Vice President of Government Relations for Avalara. I've been here 12 years, came here from, I have a very similar background to Steve's. I came from state government, worked in the Department of Revenue for 10 years, worked for a legislature for a few years, and then ran a thing called the Streamlined Sales Tax Governing Board.
Great. Thank you both for being here today. We do have our first poll question. That should be up on your screen now. And the first poll question is, what industry is your company? And we have several options there. Be sure to scroll down and make your selection and then hit the submit button. And we do have a lot of content to get through today, so we won't be showing poll results today. So I'll just give you a moment to answer that and we will move on. All right, that is all I have for housekeeping. So I will pass it over to Scott to get us started.
Thank you, Ashley. Welcome, everybody. We're glad to have this opportunity to present some advice, guidance, direction, good points when you're trying to be the government's tax collector, and make sure that you have the tools that you need to be able to understand what they expect of you, and specifically what they expect of you in an audit. So today we're going to talk about nexus considerations, what to expect during a sales tax audit, audit best practices, and taking action, what you can do. Nexus consideration. What this slide presents is the perspective of sales tax compliance in the United States from the point of view of a marketplace. Imagine you're somebody who's helping somebody else sell what they make or sell what they sell. And you have lots of customers in lots of different industries. To do it correctly, and by correctly, I mean in a way that protects you, in a way that gives you all the capacity that's necessary to make sure you're doing the best job you can to be right. You need somewhere around 9,000 tax codes, because with all the things that are taxable and exempt across the 45 states of District of Columbia and Puerto Rico, plus the cities in Alaska that have a sales tax, it takes that many different tax codes to make sure that you can accurately reflect what's taxable, what's exempt, and things that are taxed at a different rate. You have to be able to do this for 20 different industries. And some of these industries have radically different tax compliance problems or complexities than others. 330 different categories of product, 30,000 jurisdictions. And they're, in some cases, very simple. The state of Wyoming has a state sales tax, and the local sales taxes are all county-based. Really simple, oddly enough, compared to, say, Missouri, which has 2,000 taxing jurisdictions with a variety of different forms and different purposes and different rates, and they overlap each other. 82,000 rates when you add all the possibilities up together. And then 900,000 rules. What is taxable, how one state taxes something that's identical to something else that's also taxed in a different state, but taxed differently in the other state. This is a very complicated business that we're in. The first thing you need to know when you're collecting sales tax is where you have to collect sales tax. And that's determined by where you have what's called nexus. Nexus is the word that describes a connection between you and the government. And it's that which gives the government the right to make you a tax collector. For the longest time, that was a very simple thing. It was called physical presence. You had to literally physically be inside that state before that state had the authority to make you collect their sales tax. In 2018, that changed. And when a concept known as economic nexus was added to physical presence, both of them are still there. And they both have very different meanings from the perspective of the tax collector, you. Economic nexus is that thing where you have an obligation to collect sales tax based upon the amount of sales or the amount of transactions that you have in a state. Three other types of nexus that exist out there today. One called affiliate nexus. You're part of a control group, and one of the entities in the control group is present inside of a state. You may not be. That state may have a law that says if any part of a control group is inside the state, the whole control group is inside the state. It was really more applicable to the days when it was just physical presence. Click-through nexus, the same thing. You use an affiliate marketing program where you encourage people to put a link on their website to your website, and that every time someone clicks on that link, your link on someone else's website, and makes a purchase, you give that person a commission. It's called click-through. And what the states have said is that that person has become an agent of yours, and they're in that state making sales on your behalf. Therefore, you're there. And then Marketplace Nexus. Marketplace Nexus is usually happens when you are storing your inventory in a marketplace's warehouse. Physical presence. This is Marketplace Nexus and Physical Presence Nexus are kind of the same thing. We just don't think of it that way, because we've just assumed that because all the states require marketplaces to collect sales tax, regardless of what and whose products being sold, we tend to forget the fact that our products are inside somebody else's warehouse, and that is physical presence. And physical presence can create nexus for sales tax and corporate income tax. So these are things you need to keep in mind as you're doing your business around the United States. This slide is types of things that states look at when they're trying to determine whether or not you have physical presence. Payroll. Every state that has a personal income tax requires employers to withhold the personal income tax from their employees. Well, you have to be licensed with the state to do that. And it's not unusual at all for someone, they know HR, somebody hires somebody in a state, HR takes care of everything, HR done their job, they've got they know they have to have a license with the state, and they're withholding the tax, and they may not ever tell the tax department that they put an employee in the state. And the tax department gets a letter from the state saying, you've got employees in my state, and that creates physical presence. We need to have a conversation. Multi-state locations, multiple stores, warehouses. I've talked about marketplaces, on-site field service and repair and supervision. One of the ways that some industries, the service industry specifically, are really caught in sales tax administration is when they have to go in and install something themselves, or when you hire somebody else to go in and install something or to repair something. If you are the person that's hiring the person that's going in to do the repair or the installation, you are there. And so that's physical presence. And in a physical presence world, you start collecting sales tax the moment you make physical presence. The next slide, this slide here is, in all the presentations I give, I tell people you really only need to have one slide when you're talking about sales tax compliance, and it's this one. And this is the slide that defines what the economic nexus thresholds are around the United States. As I said, economic nexus came to us in 2018 in a Supreme Court case called South Dakota versus Wayfair. And in that case, the Supreme Court of the United States gave to South Dakota the ability to require retailers anywhere, gave to the state of South Dakota the ability to force retailers anywhere to collect their sales tax. And South Dakota's law is very simple. You make more than $100,000 in sales into their state, you have an obligation to get a license to collect their sales tax. Well, this chart shows you, and that $100,000 is what's called economic nexus. This chart shows you what the different economic nexus thresholds are around the United States. South Dakota's original law was $100,000 in sales or 200 separate transactions. States have started to repeal the 200 transaction component to their state, of their nexus requirement. You can still see there's a number of states that still have it. That will change. They will continue to get rid of that as time goes on. But as you can see, California, it's $500,000. Texas, $500,000. Mississippi is $250,000. Colorado's $100,000. These are the thresholds. And as I told you, in physical presence, if you have physical presence in a state, they expect you to collect sales tax the very second you have physical presence. Economic nexus is different. You get to make sales into a state up to the threshold. And if you never cross the threshold in a calendar year, then you don't have to collect sales tax for economic nexus because of economic nexus. The moment you go over the threshold in a calendar year, then you develop an obligation to get a license and to start collecting their sales tax. And that might last a year. It'll last as long as you have economic nexus. It may last a year past the day when you stop having economic nexus. Steve, let's talk about mergers.
Okay, so expansion of physical nexus. So, I would anticipate that a company as it emerges with time is maybe not going to have the same business model as it did on inception. And most companies, I would expect that they want to grow and they want to increase their sales year over year. And that might involve expanding their activities. So I'm going to back up to what Scott was mentioning. And as you can see, all these triggers that create physical nexus, one of the things we want to impress, and I believe Scott mentioned this, having somebody in the state that's doing something generally is going to create nexus, among these areas. But if they travel into other states, an expansion, so you've had a particular way of doing business and you got the field sales staff in that second row, they're going to expand their territories. That would be a classic exemption of expansion of physical nexus. So one of the misconceptions that I have in my daily conversations is that a lot of companies don't know that visiting the state also typically or generally speaking is going to create physical nexus. They often think, well, their office is based in Tennessee and they go to New York, but they don't live in New York. They don't have an office. It doesn't matter. Generally, when you conduct and you're expanding your physical nexus into other states by doing those things, that would be an example. Or let's say you do a merger and acquisition, and now they're a related entity, whether they become a subsidiary or they actually merge into the company. That company may be bringing in more states that this company did not have. The acquiring company did not have nexus. They're bringing in another activities of the related entity or merged in. And that company may have had different states where they had nexus. Well, now it's all together. That's another example of creating, expanding your physical nexus. So you have to be very mindful on how the company is expanding, what's it doing, does it create triggers in additional states? Because if you let it go and you're not keeping in check, what happens, as Scott mentioned, you're supposed to get registered when you have nexus immediately. If you don't, or if that other company is coming in and things are left unchecked, maybe that other company closed out its registrations, merged into this company, but they're keeping their same operations. They're still doing business in that state that the acquiring company never did business. Well, they closed out their old permit and now nothing's getting reported. Whereas the acquiring company, well, they just inherited states they should have kept reporting. And so it's another implication of you're expanding physical nexus and it's creating problems. The next one is increased economic nexus. So Scott was talking about how all those sales, the different thresholds. It goes to my point as well. Well, as you're expanding and you're trying to increase annual sales, maybe last year you're at $86,000 and that's counted towards the threshold, but you didn't go over it. But in this year, finally, when this year, or 2020, let's say 2023, you didn't go over, 2024, you did go over because you're expanding. Hey, great. You made more sales. That was the goal, but you crossed the threshold. And here we are in January of 2025. If you're not looking backwards at 2024 to see if you did create nexus, that's going to create a problem. You have to get registered timely after you create nexus. So as your sales are increasing, whether it's through the acquisition or you expanded your territories or whatever you did in your business that just enhanced sales, you got to be mindful that you may be crossing the threshold at this point. So the changes in business structure, we talked a little bit about that in the expansion of physical nexus, but reiterate that the restructuring, the merger and acquisitions, you made a bigger company somehow, or you got related entities. That means be mindful of more, right? You got more to deal with an enhanced business structure. So you need to be mindful of the ways that you create nexus, when you created nexus, and hopefully you didn't let it go so far that now you got a liability. Data integration challenges, that's key. because, okay, great, I know where I have nexus. I know where I need to be registered, and I want to file. But it kind of defeats the purpose that if your data is not in proper order, it's not capturing. We're going to get into audits in just a minute about methodology of reporting and maintaining accounting. If your data is completely in disarray, that's going to lead to errors on the tax return. Most likely it's going to lead to problems in preparation of the tax returns, and that's not good. It's another contributing factor to increased liabilities. So when are transactions tax exempt, not for profit? I would like to say right off the bat, not all states honor not for profit. That's a federal exemption, and most states do honor the federal exemption, and it extends into not for profits that are purchasing goods or services from provider. If they're a 501c3 or the potential laws that allow for not for profit, they will qualify for exemption. They have to give an exemption certificate. Often when I have misconceptions where our customer will say, well, they're not for profit, so I don't need to worry about it. Well, that's not entirely correct. For example, California taxes all not for profits. There's about 4 or 5 more states that do the same, whether it's fully taxable, partially taxable. You need to be aware and not have that misconception that all not-for-profits are exempt from sales tax. And that includes the religious organizations, schools. Often people think, well, it's a school, or hospitals. They think, oh, it's a hospital, it's for medical purposes. That's not necessarily going to be the case. The governing factor really is when you need an exemption certificate, if you don't have the exemption certificate, you got to treat it as taxable. That's your internal control. If they can't give you an exemption certificate and say, wait, I'm a 501c3, and maybe it is a state that allows those exemptions, well, where's your certificate? Please send it. Oh, I can't. I don't need one. And they give you a story that for whatever it is, they can't give you one. You better collect tax if it's a taxable product, because they're not able to substantiate their status as a qualified purchaser for sales tax exemption. That pretty much applies to all of those that you see there. Government, right off the bat, California is subject to sales tax. So if you sell something to the state of California and it's taxable, and they don't give you some sort of special exemption, which generally, often I would say they don't, you have to collect California sales tax from the state of California. And there's probably about 4 or 5 other states that do. But government, on the other hand, they're typically going to be self-regulating. They typically know that something that's subject to sales tax, they're either maybe going to have their mechanism to pay themselves the tax in some way. But if somehow that government is, maybe it's a local government city, we're talking about federal, state, and local. It's not mentioned, but some of the locals, if they don't properly not doing what they're supposed to do, the retailer generally is going to still be responsible. So most states offer exemptions for state, local. Federal typically is always exempt. State, most of them. Local, most of them are going to be exempt. But make sure you get your exemption certificate. That's the most thing to do. The intended use of goods. So, for example, let's go right to the manufacturing. Manufacturing, the exemption is for qualified equipment used in the manufacturing process. So most states, and I want to say generally speaking, and typically a state will say the equipment is used in the manufacturing process, conveyor belt, or it's chopping something, or it's mixing something that goes into the manufacturing process. Typically furniture that's in the lunchroom of the manufacturing company has nothing to do with the manufacturing process. So you have to look at the intended use of goods. Agriculture, usually it's something in the harvesting, the tractor, the blades, whatever is used to harvest that. Things that the farmer may buy, I don't know, hats. It's kind of ridiculous, maybe, but still they wear it while they're going through the tractor. Yeah, but that's still really, they don't have to wear the hat. So typically you have to be careful about what you're claiming for the agricultural exemption. Merchandise that's intended for resale. In fact, I just had a call earlier where a a store that's buying store fixtures from a fixture manufacturer, the shelving, so they can put the merchandise. The person I was talking to thought, well, that's for resale. I'm selling to a store. Well, when you think about it, the store is not going to resell that shelving. They're using it as typically what's a capital asset. So resale certificates, be mindful of that they're completely filled out. Maybe do a little bit of due diligence. Typically, that certificate is offered in good faith. So you don't necessarily have to question every single one of them and investigate. But if you see something that just doesn't look right, question it, because usually having a certificate that's not filled out completely, things are missing. The date, they just put in I don't know, the month and the day, but the year, that could lead to ambiguity. So be careful with that, those forms of the certificates you get. So I'll turn it back over to Scott.
Thank you, Steve. You know, that's a great topic, because we forget sometimes that the tax almost always falls on the retailer. And when it comes to a sales and a use, we call them a sales and use tax audit. They're mostly a use tax audit, and we'll talk about that in a few more slides. From the sales side of it, a sales tax audit is when they're looking to see whether or not you've made a sale to somebody, you didn't collect tax. Then they want you to prove why you didn't collect tax. And to Steve's point, if you don't always have to question the validity of the exemption certificate that someone gives you, but you better have an exemption certificate. If you have nothing, the state presumes that it should have been taxable, and you have X amount of time then to prove up why you didn't make that, why you didn't charge sales tax when you made that sale. So this is a really important thing. Exemption certificates are critical. They are the bread and butter of a sales side of a sales and use tax audit. And on exempt sales, I showed you a little while ago the map of the United States with the different economic nexus threshold. Well, one thing that doesn't show up in that economic nexus threshold map, the simple dollars side of it, is what type of sales you have to include when you're deciding whether or not you have an obligation to get a sales tax license. And that is this slide here. Where does economic nexus include exempt sales? It's a little bit misleading to look at a map that shows South Dakota and North Dakota both having $100,000 as their economic nexus threshold. Unless you dig into it and realize that in North Dakota, that's a taxable sales threshold. So it's $100,000 in taxable sales. South Dakota, it's $100,000 in gross receipts. Exactly the same $100,000 threshold. They could not be more different from each other. North Dakota doesn't want you to include exempt sales. They don't want you in their system if all you're doing is selling exempt things. South Dakota wants everybody in their system. North Dakota only taxes tangible personal property. South Dakota taxes everything, property and services. As Steve said when he was talking about exempt sales, a lot of states don't, every state takes the federal income tax nonprofit status that they grant to an organization through their income tax. So if you're exempt from federal income tax, you're probably exempt from state income tax. A lot of states have used that federal income tax, 501c3, 6, whatever, as a way to designate the charities that they're going to exempt from their sales tax. If you do it that way, there's no work involved. You don't have to think about who you're exempting. You give that to somebody else. There's a lot of states that want to have a lot of control over who they're exempting. And for example, North Dakota, the 501c3, the designated designation that comes from the federal government, carries through to their income tax and to their sales tax. Well, South Dakota doesn't have an income tax. So they don't care about your 501c3 designation from the IRS. What they care about is whether or not you provide relief to people in South Dakota that the government would otherwise have to provide something too. So they have a thing what they call the relief agency status. If you're a relief agency, you're exempt from sales tax. You have to apply for it. If you sell products to the Catholic Diocese of Bismarck and to the Catholic Diocese of Sioux Falls, South Dakota, you won't charge sales tax in Bismarck, North Dakota. You will charge sales tax in Sioux Falls, South Dakota. Sell exactly the same thing to exactly the same customer, two different states that have exactly the same economic nexus dollar threshold, $100,000, and you would have to have a sales tax license in South Dakota and probably never have a license in North Dakota. So this chart right here is one more of those charts where you have to think, okay, they both have the same economic nexus threshold. Do they both use gross receipts? Do they both use taxable sales? What about the few states that use retail sales? What is a retail sale? This is still a very complicated business, even if you have a map that shows you what the economic nexus thresholds are. So common risk in noncompliance. Misunderstanding the taxability of a good or service. All you know is the state you're located in, and all of a sudden you have to start collecting sales tax in another state. It's a mistake to assume that the way they do it is the way that it's done in your state. South Dakota, North Dakota, a great example. North Dakota only taxes tangible personal property. South Dakota taxes all services. So if you sell tangible personal property in North Dakota and South Dakota, and it comes with a warranty, that's probably exempt in North Dakota. It's going to be taxable in South Dakota. Don't assume that what you know will get you by in the next state. Letting the tax code determine the taxability of your good or service. If you're going to automate your sales tax, you have to do that. You have to rely on tax codes. But it's incumbent and an imperative that you pay some attention to what that tax code says and think about what it is you're actually selling. I mean, folks like Avalara we will gladly make sure that if you pick a particular tax code, that will give you the right tax answer. But the tax code you pick has to be the tax code that represents the things you're selling. And this is the common error that we're seeing today in audits, is that folks come in and they think they are software as a service. And the state comes in, state audits, and the state says, you're not really software as a service. You're a service provider who's using the software that you have to provide a service to somebody else. They're not actually using your software. You're using your software, which may change your taxability altogether, because you may be in a service that's exempt, but you may not be. And sometimes services are treated differently based upon whether or not they use the communication system. There's a number of people who truly provide software as a service that involves the telephone lines, the internet, some way that it communicates between customers using the communication system, and you might find that you're subject to some state's communication excise tax. And then not knowing where you have nexus to reporting obligations. Where are you making sales? Where do you have employees? Where do you have property? Where is your inventory stored? Are you delivering anything in your own goods? Are you hiring contractors to go into a state and work on your behalf? All those things you have to keep track of. All those things are what determines whether or not you have an obligation to collect sales tax somewhere. Let's have poll number 2.
All right, we're a little over halfway through, so let's get to our second poll question. That should be appearing on your screen in the center. It should be a pop-up. And the question is, has your company completed a sales tax audit within the last 3 years? And the options are yes, I managed or assisted with that audit. Yes, but it was before my time or with a different team. No, or maybe you're not sure. So you can make your choice and hit submit for this second CPE poll question. So with that, I will pass it back over to Steve.
All right. Just a moment. Oop. What auditors are looking for? So I could say this. This is what I used to look for. So let's just go through the bullet points. Are tax returns accurately reflecting taxable and exempt sales? Well, this just goes back to what Scott was talking about, is if you're using tax codes, make sure your tax code is correct, because those tax codes have independent tax decisions that are respective to each of the state tax laws. It's going to likely vary by state. Some taxes are going to be the same across the board, but often there's going to be variances. So your tax returns as your methodology of reporting, you look at your tax return, the auditor's looking at, okay, see you have no sales. You're claiming everything is exempt, or maybe it's all taxable. Maybe it's a combination of both. That's where the auditor is going to start to evaluate. Let's see it. Big picture here, as we go through the bullet points, the auditor is going to be looking at the source. Prove to me that your numbers are correct. So the next one is the proper amount of tax collected correct. And that could be incorrect, and that could be if you're not set up properly to calculate the right amount of tax. Now, Avalara, if we're talking about Avalara software, it does have the right collection rate, but somehow if you're not using AvaTax, some common errors could be that you're not using the right tax rate, or you think something is exempt and you're not collecting tax, so you've under collected tax. By the same token, that wrong tax rate could lead to over collecting tax if you're using a higher tax rate than is, or on the reverse, if you think that something was taxable and it's actually exempt and you're collecting tax, that's still going to be a form of over collecting tax. So the auditor is there to see what were you supposed to report. That is the basis of everything in an audit, and they're comparing to what you actually did. Does the amount of tax collected in the accounting records match what was reported? So typically that's done. I would look at the tax accrual account. You have the sales tax payable account, you're accruing tax as you collect. And if I saw that, oh, they collected $10,000 of tax in the fourth quarter of 2021, but on the tax return, it shows $5,000 of tax reported. Well, why did you collect more than what you reported? First thing is a reconciliation of the entire audit period. Audit periods usually go 3 to 4 years. So the auditor is going to be checking all the tax returns for that entire period and reconcile. So it's very straightforward reconciliation. Explain to me why there are differences. Does the amount of taxable sales in the accounting records match the reported amount? So you could have the tax collected that appears to be correct, but if your taxable sales on your books and records show way higher than what you reported, there's definitely a disproportion, because why do they not match? You have $80,000 of taxable sales reported here in this fourth quarter. Why do you only have $30,000 reported on the tax return? So that's a big red flag. So, as I go through this, these are things that you can check on your own. Conduct your own internal audit. So these points are pretty straightforward. Does what you have in your books and records match the tax return? Does the amount of exempt sales in the accounting records match what is claimed on the tax return? So again, it's a reconciliation, and what could be very dangerous to the point, if you're going to make an error either way, is if you overclaimed your exempt sales, that perhaps you had a population of customers, and at the time the tax return was prepared, you thought, okay, all of these are exempt customers. Later it comes to mind after the tax return was filed that, these 10 customers were not exempt. They're actually taxable, and you changed them in your accounting records and they're now classified as taxable. Well, the tax return's already been filed. Now a year has passed, the auditor's looking at all of these records and they see an inconsistency. You overclaimed exempt sales. On the same token, you may underclaim the exempt sales. Either way, it's going to result in an error. And so that's something, it extends to exempt sales. Are exempt sales properly supported with the exemption certificate? So here's an example of what I would do. Auditors can test in different ways, and you have 3 years of what could be several exempt sales. And when there are several exempt customers, most often, if it's in the hundreds, the auditor typically isn't going to look at each one. They do is they conduct a test. And what they'll do, there's different ways to do sampling. I'm going to give you an easy one. That would be they want to test 2 quarters, probably 3 quarters in a 3-year period at random, probably different years. And what they're doing is they're going to take a sample to see if you claimed $100,000 of exempt sales and you've got 100 certificates, that's where they'll look at the certificates to match that. Okay, this sale is supported, this one isn't supported, is supported, and now we got, out of that 100 customers, 10 of them weren't supported. Where's the certificate? Okay, go get the certificates. Turns out that it was a mistake, that 5 of them were actually taxable, which was thought to be exempt. Well, that's a 5% error rate. So they could, and when they compile all these test periods and they can come up with an error rate, they're just going to apply that error rate to the population, because it's inferred that if there's, even with a sample, if there are mistakes, it likely occurs in the general population of exempt sales. So it's very important that you maybe have a matching, you have an exempt customer, have your certificate, one for one for one. And that's how you can support it. Otherwise, it's going to be deemed, if the item is taxable, you don't have an exempt certificate, and you can't get the certificate, then generally the auditor's going to say, okay, it's taxable. Was use tax properly reported on taxable goods or services used by the company if sales tax was not charged by the vendor? There are different reasons why the vendor didn't charge tax. One, they just don't know they're supposed to, and they should have. Number two, they don't have nexus. There could be instances where they don't have a duty to collect. That is going to fall on the buyer to report the use tax. The state wants its money one way or the other. So if the retailer is not required to collect the tax, somebody's got to pay the tax, and that is the buyer. If what the auditor would do, or what I would do, is I would ask for the federal income tax returns. Show me your capital assets that you're depreciating, because we know that's not for resale. Now I want to see the purchase invoices for those acquisitions of assets. And then what I would do is look to see if tax was charged by the vendor. If tax wasn't charged by the vendor, then I'd go to the tax return to see, okay, did you self-report the use tax on this $80,000 piece of equipment or set of computers or furniture or office supplies? That did you pay the tax or not? Is this maybe a widespread problem? And sometimes I found they didn't report any tax. They thought, great, hey, I didn't have to pay sales tax. Well, yes, you do. You have to pay the use tax. So that could be an issue if you're not, typically if you're buying something for your use and it's taxable in your state, then you need to pay the use tax, or you're going to pay sales tax to the vendor. So if use tax was accrued, does it match what was reported on the return? Simple reconciliation. In my test, I would say, okay, yeah, you did accrue tax, and you have in your use tax accrual account, I can see over time you're accruing this much, but it's more than what you paid the state, or it could be less than what you paid the state. So there could be an underpayment or overpayment. Again, it's another form of reconciliation. Overall, does the company have the correct understanding of the taxability of its product service? Again, it goes back to what Scott said. Make sure you understand what is taxable and what is exempt. So basically, it's 4 audits: correspondent audit or office. Office audit means that they're not going to come to the place of business. They're going to do everything remotely out of the auditor's office. That doesn't necessarily mean you're going to come into the auditor's office. Usually they might be in another part of the state. They could be out of the state and you have nexus, so you're subject to audit. But nonetheless, the auditor stays in their office. They request the books and records. Nowadays, probably a lot of it can be done electronically or the cloud, which makes it a lot easier now for auditors to review records, because now it's electronically accessible versus the old days of shipping boxes or packages with documents. It's a lot easier nowadays. So the office audit saves time for the auditor of travel. The state might be trying to save money on travel expenses. Nonetheless, it's going to be the same type of audit, generally speaking. The field audit is what I did mainly, going out to your place of business. You get put in a room and I ask for all these documents, and that's where I conduct the audit. I would probably do a tour to see, particularly with manufacturing operators or retail, or if there's activities happening at the location I want to see. I want to be taken on a tour to look at it. So there's most of the time they do want to be at the place of business so they can actually see what's going on. Combined audit of all taxpayers in a group. Well, that could be industry. Maybe the audit, the state is targeting a particular industry because they're either seeing a lot of mistakes on tax returns, or it could be a law that came out a year ago or 2 years ago, and they want to see if that particular industry is properly reporting, or for whatever reason they suspect that there could be errors in that particular industry, so they could go combine. Or maybe it's a lot of related entities, and so they're all each a taxpayer within their respective entity, legal entity. Washington has the business and occupations tax, and they also have the retail sales tax. Those two types of taxes are reported on the same return. So the auditor is typically not going to ignore the business and occupations tax, B&O tax, and just look at the retail sales tax. Or they may have a policy that, like Hawaii, I believe they look at all of the state taxes, or at least most of them, and they're not just going to do the sales tax. They figure, well, they already got somebody out there, they're paying somebody to be out there, might as well have them look at everything, or mostly everything. So I'll just kind of go quickly. Obviously, if you make late payments, the state's going to see. Most of this is automated, so you've got programming where it's going to red flag returns. They're going to wonder why, what's going on, are there errors, or they don't have the money, they're keeping the tax, and they didn't make the payment. What's going on here? Inconsistent reporting patterns, and this might be legitimate if you have a seasonal business. Let's say it's mainly Christmas lights and Christmas decorations. Probably most of it's going to be in those months leading closer to the later part of the year. But it could be mistakes, and often the state is not going to take that and make presumptions about seasonal business. They're going to say, this is very inconsistent, up, down, or there's a period of time where it's consistent and then all of a sudden spikes up. And that could be reasons for errors in the reporting methodology. Large amounts of exempt sales could be legitimate, but often what I would find is there was a misunderstanding. Either the exemption certificates weren't obtained and they turned out to be taxable, and there were misunderstandings between the seller and the buyer where it was thought to be exempt. And large amounts, if there's a big error rate, that means big tax. Lack of consumer use tax reporting. Maybe there was use tax reported in a number of returns, and then it wasn't, and there was, or all of a sudden it stopped. That could cause a red flag. Having nexus and not registered. This is kind of a bit involved, but there are ways that are companies that could be in one state in California selling into Texas. Texas somehow found out and suspect that this California company is supposed to be collecting, and they're not registered. Texas has the right, their jurisdictional rights, that they see sales are made into their jurisdiction, and they'll contact California. Issuing resale certificates with no registration, well, that's going to be an issue where you've got to fill out all the certificates with a number and a tax registration. Trickle up means I make sales to this particular customer of mine. The auditor gets audited. State somehow wants to trace it back to me. Competitive whistleblowers, those are the people that maybe have a vengeance for their competitor and say, hey, go after them. You know, I got audited, or I want to level the playing fields. So these are we have some factors that we have seen. The aggressive states, Washington, typically, most of the time when I've seen appeals for petition penalty waivers, they don't. They just simply will not do it. Even if World War III broke out, they probably would still assess a penalty. Each state, California tends to relieve penalties, but they're very strict, very by the book. And if you can prove to them that there was no negligence and it was honest mistake, they will, but often in many ways they don't. And so it follows the same suit for many of the states.
Okay. It's time for our third CPE poll question, which is, what type of business growth do you expect in 2025? This is a multi-select, so you can pick multiple ones and then hit submit to respond to this third CPE poll question. And we have about 10 minutes remaining, so we'll go through these next sections a little faster. I'll pass it back to Scott.
So now we're going to talk about audit best practices, and Steve's going to go through a number of things that, in his experience as a former California auditor, would produce really good positive output.
Okay. When you get a notice, don't ignore it. Work with the state. If you need to buy time, often extensions can be granted, but tell them that you're working with your tax advisor. Tell them your accounting department is trying to resolve it, but at least they'll see some effort. Statute of limitations, sometimes I don't have to worry. The statutes will protect me. They don't. If you don't file tax returns, statutes don't apply. Books and records. If you got messy books and records where you're missing, could be due to accounting errors. The mismanagement of things got thrown out, maybe not intentionally necessarily, but they're just missing, or your computer software you didn't save things, or it's in another system and it's not readily available. That could create problems. The kickoff call really is to work with the auditor to understand their business, be prepared to talk about your business, and maybe have an advisor in the background that might help you get organized. That's what the kickoff. Be respectful. I'm a former auditor. I appreciate it. Look, let's just get this done. And so when you take a cooperative, now I'm not saying to let the auditor just walk all over you, but be able to defend your position in a professional way. Work with the auditor. Generally, auditors are there just to get the tax that's owed to the state, no more, no less. To manage the audit, that means don't just sit back and let the auditor do everything. You might want to manage the audit that if they say, hey, I need to come in on Fridays, and you have a big meeting, but try not to put the auditor off, manage the pace of the audit. If the auditor is being a bit aggressive and they're saying everything is taxable, and try to get it to where you say, well, there are exemptions, we just need to get them. Don't over volunteer information. Bottom line is simply this: if the auditor asks for it, be truthful, honest, give them the information. If they don't ask for it, don't volunteer the information. Get everything in writing, over communicate, that way it's documented, so later on it's not, well, I thought you said this, no, I said that. Track your deadlines, make sure you meet your deadlines, or request a deadline if you haven't already asked for several and you can justify it. Try to complete the audit as soon as possible. The auditors sometimes take their time, and they just kind of, not to rush them. There's a certain balance that you want to present because you have a business to run. Audit findings and draft schedules. Carefully look at your audit findings. If you don't understand the audit findings, give the auditor a chance to explain them. Maybe have a tax representative to just say, hey, I'm going to let my tax representative handle it. Appeal. You do have, generally in all states, you have the right to appeal findings, and then just go through the channels. Nothing is final, because the appeal might reveal that no, the auditor was incorrect, or maybe you couldn't prove something at the time. Now you can, and you actually hopefully can reduce your time. And so we suggest, if this is way over your head or just over your head, or you don't have the time, get a tax expert. There are consultants like what I used to do that specialize in sales and use tax, not only taxability, but defending clients in audits. So that's for you, Scott.
So what do you need to be doing? And what should you be aware of? Taxability of products and services varies by state. Don't count on what you already know. Tax laws change. They change all the time. January 1, 2025 was the busiest tax law change I've ever seen on a January 1. Sellers are liable. So they almost never audit buyers. They may audit a seller as a buyer, but they start by auditing sellers as sellers. Sellers are liable for things. Sellers are liable for not collecting the right amount of tax. So if they do look at your sales, they're looking to see whether or not you made an exempt sale to somebody, but B, they want to make sure that you're collecting the local rates right. The majority of states have local taxes, and that state auditor is looking to see that you have collected those taxes as well. It's critical that you document when you don't charge sales tax. It's sad that sometimes it costs more money not to collect sales tax than it does to actually collect the sales tax because of the effort you have to go through to maintain that documentation. Lack of valid exemption certificates is a huge audit problem. Incomplete forms, missing signatures, missing dates, big problem. Wrong form. Kentucky's got 17 different exemption forms. You have to pick the right form. It has to be the form that's applicable to the buyer. Not you, it's the buyer. And so these things are, and in some states, they will penalize the seller if the buyer presents a wrong form. It's really very important that you pay attention to the form that you're getting from someone. Consumer use tax, as I said, that they will audit you they're auditing you because you're a seller, but a lot of also audit you because you're the buyer. So again, as I said before, we call it a sales and use tax. Well, the sales tax side of it is when you're not collecting sales tax or you're charging the wrong rate. The use tax side of it, which is where they collect most of the money in an audit, comes from assessing you tax on things that you've purchased to operate your business when you weren't charged sales tax on that purchase. It's less so today because of because everybody's a retailer now and everybody has to collect sales tax, but it's still a big deal. And that's the first thing those auditors go for, is they want to look at all your purchase invoices. It seems inconsistent that I can do a sales tax audit of you and look at your invoices and look at the things you purchase, but that's how they make their money, is on the use tax side of this. Personal property, freight, services. There's a number of states out there that tax services. If you get audited by someone from South Dakota, you should assume that they're going to be looking for your engineering services, your architectural services, your accounting services, your legal services. All those things are taxable in South Dakota. They're taxable in New Mexico. They're taxable in Hawaii. Those three states look for services when they're doing the use tax audit. Some industries are more, I wouldn't say they're high risk. They're high risk. I will say that they're high risk. Construction, hospitality, retail is big when it comes to use tax. Let's see. Steve, this is for you.
Yes. So we'll just go over quickly the consideration audit preparedness. And so really build credibility and trust. That's part of the mutual respect between the auditors, and to be accurate, transparent, and well organized, having your books and records ready ahead of time. Support accurate validation, simply have your exemption certificates. That's the bottom line. The due diligence process, streamline diligence process, showing your readiness, work with the auditor, and you want to reduce those red flags, but self-identify those red flags. You want to be organized financials, that you want to be aware of your trends. Are they going up? Are your profit margins and growth? Mitigate risks. So again, do your internal audit. And I would say that what this would do is reduce those compliant risks, which could deter investors if you're publicly traded or PE, private equity. And so that would be a concern. So we went over this. Statute of limitations don't apply because you're not filing tax returns. If you are filing returns, they do apply. You're inviting sales tax audits if you have red flags. We discussed a lot of those different trigger points. The responsible persons rules depend on, often it's called corporate officer tax, corporate officer liability, or it could be other members of the organization where they're responsible to prepare the tax returns. It's right up front at registration point. They want to know who that person is. If it changes, that person can still be held liable personally as well as the company for unreported taxes. Of course, sales tax interest and penalties will definitely always accrue with time and be generally going to be applicable. You want to be mindful because you might have internal auditors going through, and they're often versed in seeing inconsistencies, not only for audits, but they may detect sales tax inconsistencies and non-compliance. Of course, the board probably wants to know about these types of things. Is the company compliant in all aspects, including sales and use tax? So the due diligence process, the buyer is going to want to do their due diligence, see are they going to inherit problems from the seller, and there's a due diligence that's usually conducted in the acquisition.
Okay, it's time for our fourth CPE poll question. That should be up on your screen now. You can take a moment to respond to that. We are nearing the end of time, so we might go a little over. We do have just one quick section though, so if attendees can hang out, we will get through this next section in 5 or 10 minutes. Okay, back to you.
Okay, taking action. So now we have nexus, right? That's where you have to, it all comes down to nexus. If you don't have nexus, it goes out the window. And we went over the various triggers. Register, do it timely though, because if you don't do it timely and you have unreported taxable sales where you had nexus in the past, you didn't get registered, you already have a liability. That's still reportable to the state. There are some strategies that are available, too much to go into now, just go with exactly, you have a liability if you have unreported taxable sales. Calculate the correct amount. And so Avalara's AvaTax is already as a library program for point of sale based upon zip code. Track and manage your exempt sales. Again, it just comes down to have your certificates for anything you're going to claim as exempt customer, have an exemption certificate to back it up. And of course, you want to remit the sales tax to the authority with your returns timely and accurately. We've talked a lot about the issues and problems and risks, and one thing that could be done as risk management really comes down to where do you have nexus? And a study will accomplish these things. Where do you have nexus? When did you create nexus? And how much do you owe if you have a liability? Because as Scott said, once you create nexus, you got to start reporting. It could be all exempt, all taxable, could be both. But if you've got unreported taxable sales, it's a liability. And so there are ways that in my particular office, we do conduct nexus. It's called a premium sales tax risk assessment. And what we'll do is conduct the nexus. And it goes back to where do you have nexus and do you have a historical liability? We're still before going before government. This is all happening before government, but you should know what you owe, where you owe it, and how much before you approach government. The voluntary disclosure program is like a tax amnesty, but what it offers is penalty abatement. It limits the liabilities in most states to 3 to 4 years, even if you owe more tax. And often there are a couple of benefits that includes your registration. It kind of puts things to bed. Not necessarily that the state could always come back later, but very, very unlikely that they're going to double spend time looking at a historical period. And so the voluntary disclosure is a very good means. What we do is we represent our clients to get them registered, file the returns, get the penalties abated. Could be only owe 6 months of tax. But the point is we strategize to get the lowest amount of tax that's allowed by law and to get you compliant. And those are the ways that you can determine liabilities and then provide resolution.
All right, that brings us to the end of our presentation. We are past time, so we unfortunately don't have time for the Q&A today, but I want to thank Steve and Scott both for presenting this at Crush and for doing this webinar so we could bring the content to a bigger audience. So to close out today, if you qualified for CPE credit, you can download your certificate now in the CPE certificate engagement tool. Your certificate will also be available in a post-event email that you'll receive later today. So thanks for attending. We hope you enjoyed this session from Avalara Crush. You'll receive that post-event email later today with a link back to this console, which will have the on-demand recording, the slide deck, the additional resources, and that CPE certificate. So we hope to see you at another webinar soon. Thank you.